All right, let's talk about an industry that most people have completely written off. I mean, it's a sector that a lot of folks would call totally uninvestable. But what if some of the world's smartest, most patient investors are seeing something that the rest of us are missing? Yep, we're talking about coal, and we're about to dig into the surprising, almost hidden investment case that's being built right under our noses.
To put it bluntly, as the investor Monish Palbrai says, coal is now a four-letter word. It's an industry facing just immense pressure from ESG, from regulators, from public opinion. Banks won't touch it, insurers are backing away, and for most people, it just screams past, not future. And that brings us to this really fascinating puzzle. If coal is such a pariah, why on earth are some of the smartest investors in the world even taking a second look? Well, the answer is pretty surprising, and honestly, it has less to do with coal itself and a whole lot more to do with a powerful mental model for how markets really work.
So the key to unlocking this entire investment thesis is a concept called the long cycle mental model. It's really all about the time it takes to bring new supply into a market and how that delay can create these massive, predictable cycles of boom and bust. At the very heart of this model is one core idea, the gestation period. It's really just the time lag between deciding to build something new, whether it's a warehouse or an oil tanker, and that new thing actually being ready for business. This one variable, it changes everything.
Just think about the difference. Industries with short gestation periods, like warehouses, they can respond to demand super quickly. If there's a shortage, new supply can come online in less than a year, which keeps prices from getting too crazy. But industries with long gestation periods, we're talking office towers or massive oil tankers, that's a whole different story. It can take 5 years, maybe more, to build one. And that huge delay creates the perfect storm for chaos.
So here's how that chaotic cycle plays out. First, high demand and low supply cause prices to just go through the roof. Seeing those obscene profits, everyone and their brother decides to start building new projects, all at the same time. But because of that 5-year delay, no new supply actually shows up for years, and prices stay high, which just encourages even more building. Then, disaster strikes. All of those projects, started years apart, finish at roughly the same time. A flood of new supply hits the market all at once, creating a massive glut that just absolutely crushes prices for years.
Okay, so how does this model apply to coal? This is where the story gets a really interesting modern twist. To see the opportunity, we have to make a super critical distinction, because not all coal is created equal, not by a long shot.
So on one hand, you've got thermal coal, the kind used for power generation. That market is clearly in a long-term decline as the world shifts to other energy sources. But on the other hand, you have metallurgical coal, or met coal. It's a crucial ingredient for making steel. And that market, it's not dying, it's stable. It's even expected to grow, driven by things like infrastructure and development. And for right now, there just aren't many viable alternatives for making new steel at scale.
And this is where it gets really unique. For met coal, a combination of modern forces has basically created the ultimate long gestation period, artificially. ESG pressure has made the whole industry a pariah. Major banks, like JP Morgan, are flat out refusing to finance new coal mines. Companies are struggling just to get basic insurance. And the environmental permitting process, it makes opening a new mine a nearly impossible decade-long fight.
So what's the result of all this? Well, new supply is effectively capped. It doesn't matter how high prices go, new players just can't get into the market easily. This has accidentally turned the industry into a supply-constrained oligopoly, where the few remaining producers, the survivors, are holding all the cards and have incredible pricing power.
To really see this in action, let's look at a case study, a company called Alpha Metallurgical Resources, or AMR. This company's story is the perfect example of a survivor that's now poised to thrive in this very strange new world.
I mean, AMR's history is a total roller coaster. The company, which used to be called Alpha Metallurgical Resources, made this huge debt-fueled acquisition right at the peak of the last cycle. When the market inevitably turned, it got crushed, leading to a massive bankruptcy in 2015. But out of those ashes, a new, leaner company emerged, focused only on met coal. And wouldn't you know it, when the cycle turned up again, it generated record profits and completely wiped out its debt.
And just think about the scale of that collapse for a second. By 2015, the company was buried under more than $3 billion in debt. This wasn't just a little misstep. It was a classic case of a company betting the farm at the absolute worst time, and it almost wiped them off the map.
And today, well, the situation is the complete polar opposite.
They now have a fortress balance sheet with nearly $500 million in cash and basically zero debt. From over $3 billion in debt to $500 million in cash, it's one of the most dramatic financial turnarounds you will ever see.
But what's really telling is what the new management did with all that cash. Instead of repeating the mistakes of the past and chasing reckless growth, they gave it back to the owners. They bought back almost a third of the company's shares, they started paying dividends, and, this is crucial, they hit the brakes on buybacks to save cash when the market got soft. It is a masterclass in disciplined, smart capital allocation.
So that brings us to today. What does the investment thesis for AMR actually look like right now at what seems to be the bottom of a cycle?
Okay, so at today's really depressed coal prices, AMR is designed purely for survival. Its all-in costs are almost exactly what it gets paid for its coal. So at the very bottom of the cycle, they're not making much money, but, and this is the important part, they're not losing money. They can just tread water and wait for the cycle to turn. And this is where the real upside comes in. Because AMR's costs are largely fixed, any increase in the price of coal flows almost directly to the bottom line. A modest recovery to a more normal, mid-cycle price doesn't just increase profits, it causes them to absolutely explode. That, right there, is the power of operating leverage.
So let's bring it all home. The investment case for AMR today really stands on 4 key pillars. You've got a bulletproof balance sheet, a disciplined management team that has clearly learned from history, a powerful industry moat that limits competition, and incredible operating leverage that offers massive upside when prices recover.
Which leaves us with the final question. You have a financially sound, well-run company in an industry with powerful, built-in supply constraints. And yet, it's in a sector that everyone loves to hate. So, is this a case of deep, overlooked value? Or is it a classic value trap? The answer really depends on whether you believe the model or the sentiment.